the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In this episode, we will discuss the week's significant developments with a cover story highlighting the employee costs in the banking sector in the light of the January 30 and 31st strike called by the United Forum of Bank Unions. We have an interview lined up with Jairam Sridharan, MD, Piramal Capital and Housing Finance Limited on portfolio diversification. In our Banking for You section, experts explain the concept of domestic systemically important banks or D-SIBs are India's too big to fail criteria. Our banking expert Tamal Bandyopadhyay discusses the extension of tenure for bank directors and its impact on the sector. At the end of the episode, we shall discuss the results of the last week's poll and ask you the question for the next one. Earlier this week, the Reserve Bank of India floated a paper on banks' expected credit loss model for loan loss provisioning. But the interesting aspect this week was the bank strike announced by the United Forum of Bank Unions on January 30th and 31st. Over 1 million bank employees are expected to go on strike for 2 days for issues related to the 11th wage settlement for bank employees. Meanwhile, the focus would also be on banks which are in the process of announcing third quarter results. So we deep dive into the issue of employee costs and why public sector banks are at a disadvantage compared to their private sector peers. Usually, the word bank is associated with an image of people sitting behind desks, processing checks, dispensing cash, and solving customer queries. For the longest period, that is the image we have had. Nowadays, a bank resembles an ATM, a check deposit machine, or if you're more tech savvy, an app on the phone. While the perception of banking undergoes a change in the customer's mind, for most public sector banks, the transition has yet to take place to that extent. On January 30th and 31st, over 1 million bank employees will go on strike for the implementation of the 11th wage settlement. The strike would reinforce the traditional notion of a public sector bank. In 2021-22, the wage bill of private banks increased by 17% compared to the last fiscal year, whereas for the public sector banks, the increase was a little over 6%. But a business standard analysis shows that employee costs at public sector banks accounted for 60% of the total expenditure. The corresponding ratio for the banks, private ones, was 40%. So are employee costs prohibitive for the public sector banks? We talked to experts to understand.
If you look at the data of the last 10 years, the total employees of private banks have increased at a CAGR of 7.6%, while for PSU banks, it rose by 2.5%. Similarly, the employee expenses in the last decade for private banks rose by 15.7%, while for PSU banks, it rose by 10.1%. So both in terms of employee additions and employee expenses, private banks have been growing at a faster pace than PSU banks. Now this is primarily because in the past decade, private players have been eating the market share of PSU banks and therefore they require a faster employee growth to feed their faster business growth.
An analysis of employee costs as a proportion of total expenditure doesn't present a complete picture. A cost-income comparison shows that disparity. Every rupee spent on wages at public sector banks generated 6.3 rupees in income. The corresponding numbers for private banks were 9.7 rupees in income for every rupee spent on wages. The difference would not be visible at top-level salaries. Public sector banks tend to pay more at lower levels than private sector banks. At the higher levels, the remuneration levels are much higher for private banks. Does that mean that public sector banks need to stop hiring?
If you look at the cost levels at public sector banks vis-a-vis their the employee costs vis-a-vis their overall expenses, that has been higher than private sector banks. Again, if you look at the last decade or so, for public sector banks, it has ranged between 55 and 65%. For private banks, it is 36 to 43%. Again, private sector banks have been more efficient when it comes to lower value added jobs employing higher technology initiatives and digitization. Going forward, we believe public sector banks can reduce costs by employing similar approaches on the clerical and sub-staff side, but they would need to continue to recruit at the skilled workforce and the senior management level.
Moreover, what about the head-to-tail ratio or the officer to the clerical grade ratio at public sector banks?
If I look at the numbers, we don't see too much of a deterioration in the ratio. Again, over the last decade or so, if I look at the ratio of senior management or officer level staff to sub-staff and clerical staff at public sector banks, that has actually improved from around 0.6 times to 1.1 times. Whereas for private sector banks, again, that has improved. We've seen a much sharper increase from around 3 times to around 19 times. Now, that clearly, again, showcases the greater employment of technology, digitization, automation of private sector banks. Going forward, we believe that this ratio is going to further increase. The proportion of officers will increase further as more and more automation is getting deployed at lower value added jobs. And I think that will, public sector banks are also working on that, and that should the ratio should continue to increase in the days ahead.
PSPs need to take a technological leap to compete with private peers. But can they do much, keeping in view the government's push for inclusive banking? At public sector banks, employee costs account for nearly 60% of total expenses. The corresponding ratio at private banks is less than 40%. From banks, let's move on to non-banking financial companies or NBFCs. As regards credit growth, the NBFCs haven't performed as well as their banking peers. With the cost of credit rising, the road seems difficult. Our banking editor Manojit Saha spoke to Jairam Sridharan, MD, Piramal Capital and Housing Finance Limited on performance and expected portfolio diversification.
Piramal Capital and Housing Finance is a subsidiary of Piramal Enterprises, an entity which is listed in the stock exchanges. Divan Housing Finance, which was acquired by Piramal Enterprises through the insolvency process, was merged with Piramal Finance. Today we have with us Jairam Sridharan, Managing Director of Piramal Capital and Housing Finance, to talk about the company's growth plans. Mr. Sridharan, welcome to the show.
Thank you, Manojit. Thanks for having me.
In the second quarter, the Piramal Enterprises posted a net loss of around 1,500 crore, mainly due to increasing provisioning for the DHFL assets. Is there a pain still left in the DHFL, or do you think the worst is over?
Two quick comments. One is that a lot of the provisioning that you saw in the second quarter, actually that was unrelated to the Divan housing portfolio. It was related to our overall wholesale lending book, but it was unrelated to the Divan housing business. We had mentioned at that time that we have substantially recognized all the problems and have made the appropriate provisions. So nothing has happened to change that situation. We are, of course, the quarter has just ended and we have not yet declared our results. So I'll desist from making more specific comments on that. Our results are out in 2 to 3 weeks, and after that we can have more specific conversation on that. But I will say that nothing much has changed from what we said last on this topic.
The retail lending book of Piramal Enterprises was around 25,000 crore. I assume that is the size of the loan book of Piramal Finance, which you want to grow to 70,000 crore over the next 3 to 4 years. Will you be focusing only on housing, or there are other areas you would like to enter?
Yeah, there are, what we are thinking of, Manojit, is a multi-product retail lending business. So let's think of it as a diversified retail lending franchise rather than very specifically focused on one product. We are, of course, going to be heavy on affordable housing. and on MSME lending. Those are going to be our two key anchor products around which we are going to build our business. The rest of the business, we plan to have a business around used car finance. We have a business on personal loans to salaried customers. We also have a microfinance business that we launched a few quarters ago. So there are going to be a few different businesses there. We also have a large digital lending business, which we originate ourselves as well as originate through partners, fintechs, etc., which also forms a meaningful part of our business franchise. So there are multiple products here, both secured and unsecured. But together, our intention is to grow, as you rightly said, to about 70 odd thousand crores over the next 3 years. And over the next sort of 3 to 4 years, you should expect to see a business at the overall Piramal level, retail, wholesale, everything put together at roughly 1 lakh crores, with a little over 2/3 of that coming from retail and the rest coming from wholesale lending.
What kind of markets, geographies you are looking at, and what is the average ticket size you want to maintain for Piramal Finance?
So the big choice that we have made, Manojit, is that we want to be present in places where traditional big ticket banks are less present, and what we are calling the budget customer of Bharat. All right, you probably saw our campaign, customer campaign release yesterday, where we've spoken about the kind of customer that we are trying to address and the kind of value proposition that we want to create for them. So our intent is to address the lending needs of budget customers of Bharat. Now, those lending needs are smaller ticket than what you would expect in a large city, in a metro, etc. So that's precisely what we expect to see. In housing, you should expect a ticket size in the 14 to 17 lakh kind of range, depending on which market we are looking at. In MSME lending, if it's unsecured credit, we are probably looking at 5 lakhs or thereabouts, 5 to 6 lakhs as the average. If it's secured credit, you're probably looking at roughly 17, 18, 19 lakhs or thereabouts as the average ticket size. And if it's personal loans, you're probably looking at a ticket size of 4 lakh rupees. And similarly for used car loans, where again we are going to be looking at about 4 to 5 lakh rupees as the average ticket.
Now, you have a very aggressive growth target to 70,000 crore in the next 3 to 4 years. Will you be open to inorganic opportunities for growth?
Yes, we are always open. See, as you mentioned in your opening remarks, we had a very large acquisition, one of the largest acquisitions in the financial services industry in the form of Divan Housing, which we completed last year in September. It has taken us this period to fully integrate all the pieces of DHFL into Piramal, and that's well and truly done now. We are operating as one company and very well integrated engine, so we are all in a good place. If you look at the history of the Piramal Group, you will see that over the last many decades, we have done tens of different kinds of acquisitions, right, in all our businesses. So Piramal as a house has been quite active in the M&A world and has created a lot of value for shareholders by strategic M&A action at the right times. That DNA we will continue to use. So we will continue to have focus on potential paths through which we can do some inorganic action, which can create value for our shareholders. So we are certainly open to that. There is nothing active that's going on right now that we need to talk about.
What is the medium to longer term roadmap? Is converting a bank to a bank is the final destination that is the group is having?
See, that depends a little bit on what the regulatory intent is on NBFCs, particularly large NBFCs. One of the things that we have all seen is that regulator has continued to make tighter and tighter, appropriately tighter and tighter regulation for large NBFCs, which create greater systemic risk, which is absolutely the right thing to do. Over time, the regulator has also expressed an interest to create more paths for on-tap bank licensing, etc., and a pathway to create more banks in our country. Now, our hope is that as we go through the next couple of years, we will see more clarity in terms of the regulatory stance on this issue. So we will be guided by that, and we will take actions in that regard. As you know, in India, NBFCs have existed for many decades and continue to be profitable and fairly stable and sustainable business model. It is also arguable, however, that beyond a particular size threshold, it is better and more stable and sustainable to have a banking business model. We are quite happy to do either of those paths, depending on what the regulatory comfort is.
Is there a plan to diversify the fundraising requirement, like away from banks to the more retail NCDs and all? Is there
Yeah, so we that's a good point. We do want to always have very diversified sources of funding. Banks have been our predominant borrowing path for the last few years, and that said, we have also done some retail NCD issues. Both last year, last year, this year has just started. So yes, we will continue to do that. You'll continue to see us active in market. I have nothing specific to talk about here. We do have a board meeting coming up in 3 weeks, where funding requirements, etc., among other things, might get discussed. So we will see on the other side of that if there is anything that needs to be disclosed to the public.
Mr. Sridharan, as always, it was a pleasure talking to you. Thank you so much for speaking to Business Standard.
Thank you so much for sharing and giving me this opportunity. Have a very good day.
Thank you, sir. Thank you.
Sridharan says that the company is looking at a diversified retail lending franchise, but they will be heavy on affordable housing and MSMEs. He highlighted that the intention is to grow to a 1 trillion rupees business over the next 4 years. In the banking business, the size of the bank has a lot to do with the classification. Just a few days ago, RBI announced a list of domestic systemically important banks. These are called too big to fail institutions in common parlance. In our Banking for You section, experts explain what these are and what they entail.
On January 2nd, the Reserve Bank of India said 3 banks, SBI, ICICI Bank and HDFC Bank, continue to be classified as domestic systemically important banks or institutions that are too big to fail. The origins of domestic systemically important banks or D-SIBs in India go back to 2014 when the RBI released a framework for classifying and handling domestic lenders deemed critical to the financial system. The RBI's move came in the wake of the global financial crisis of 2008, during which difficulties faced by the large and highly interconnected financial institutions obstructed the functioning of the international financial system, in turn affecting the real economy. The RBI said in 2014 that government intervention was deemed necessary in many jurisdictions to ensure financial stability. The tag of a domestic systemically important bank or D-SIB comes with additional capital requirements. D-SIBs need to maintain a higher share of risk-weighted assets as Tier 1 equity in addition to the capital conservation buffer mandatorily maintained by them. According to the RBI's classification, there are certain buckets under which banks are ranked as D-SIBs. SBI, the country's largest lender, has been placed under Bucket 3. Under Bucket 3, the lender must set aside 0.60% as additional common equity Tier 1 capital. ICICI Bank and HDFC Bank are placed in Bucket 1. This bucket requires setting aside 0.20% as additional common equity Tier 1 capital. This has subsequently led to the view that in the event of D-SIBs facing distress, the government would step in to ensure support. D-SIBs will also attract differentiated supervisory needs and greater scrutiny based on the risk that pose the financial system. Following the release of RBI's framework in August 2015, the central bank classified SBI and ICICI Bank as the first 2 D-SIBs. Subsequently, in September 2017, the RBI included HDFC Bank in the list. At present, HDFC Bank is the largest private sector bank in the country. It must be noted, however, that despite a sharp increase in their size, certain public sector banks which were merged recently have not yet been included in the list of D-SIBs. Large PSU banks including Punjab National Bank, Canara Bank and Bank of Baroda have all had smaller PSU banks merged with them over the last couple of years, but they are still not classified as D-SIBs.
I am the blue of the limitless sky. inspiration that led success soar high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Following the release of RBI's framework in August 2015, the central bank classified SBI and ICICI Bank as the first two D-SIBs. Subsequently, in September 2017, the RBI included HDFC Bank in the list. The norms place all D-SIBs on a similar pedestal, but there are differences in how public and private banks are run. The government just tried to bridge that gap by allowing a 10-year tenure for directors of PSBs, but differences still remain. We chatted with our consulting editor Tamal Bandyopadhyay to understand the new rule of the tenure of directors and its implications. Hi Tamal, thanks for coming on the show.
Thank you, Ishan.
Now, this week's column talks about the tenure of CEOs, which was decided last year, somewhere at the end of last year. Now, one of the things that I found interesting was at the private banks, CEOs and MDs have served for over a decade. Why limit the terms of public sector banks?
I mean, you need to ask that to the government. Why decade? Aditya Puri ran HDFC Bank probably for 26 years. 26 years. He's the, if I'm not mistaken, largest serving bank CEO of a bank of that size globally. 10 years is better than 5 years, because earlier it was capped at 5 years, 3 years, then you could get an extension of 2 years. So it's become now 10 years, but the 60 years superannuation at 60 remains. Public sector banks, right from pay structure to tenure, everything is linked to the IES civil service. So unless you delink, you can't do this. So tenure is better than 5 years, that much I can say, but is tenure enough? Certainly not. Incidentally, Reserve Bank of India now has reworked the tenure of the private banks. I think now at one stage one can have 15 years. So 15 years, and then one can return again after some gap. And the retirement age there at 70, in contrast to 16 public sector banks. So that's the thing. It's 15 years versus 10 years, and 70 years versus 60 years.
Another interesting facet that I found from your column was, does this tenure suffice? Because you said a lot of executive directors that are to be at the helm are in their 50s. If they're in their 50s, by the time the appointment takes place with all the delays, as you highlight, 264 days in one case, 118 days in another case, wouldn't it actually be a less than a 5-year tenure or something?
No, a delay part used to happen. It's not happening anymore. It's now it's pretty proactive. Much in advance. The names are announced. The recommendations have been done in the public domain, and they do join on time. So delay used to happen till recently. So this tenure of 5 plus 5. It's applicable to all the whole-time directors on the board, which means both MD and CEO as well as the EDs. So the trigger is what is happening now for the last decade or so. The promotion process in the public sector bank is pretty fast. Earlier, you would not get a general manager in less than 55. Now you are getting general managers in their 40s and EDs in their early 50s, and at least in one case late 40s. And the positions have become much less because of the consolidation. There are 11 nationalized banks now after this consolidation drive. And you take State Bank of India, but State Bank of India has a different rule. Only an insider becomes an SBI chairman, and they are governed by a different act. Now suddenly there's only 11 top positions. Okay. And there are ED, so the number of EDs also, yes, the number of EDs are 2, 3, 4, depending on the size of the bank. But again, because the number of banks have shrunk, so that top level positions have shrunk. And that's the primary reason of government coming up with this extension of the tenure. So State Bank of India is still continuing this 5-year thing, while this nationalized banks have gone to 10 years. So I would like to believe it should be extended to State Bank also.
Another concern that comes from your book, not from your column so much, was that in the last few years of a CEO, this is a trend that somebody observed and you write it in your book, that in the last few years of the CEO, loans are dispersed at breakneck speeds. And as a new CEO comes in, a cleanup starts. Does a 10-year cycle change that as well? Or no, that remains the same with it?
No, I think with a longer period, it comes more responsibility. So yeah, you are right. The cycle had been not in the current term, but till recently it was the case that if you are because people are, I mean, they were the CEOs even for 2 years, even less than 2 years. So typically, what happens when somebody comes, takes over, then the first thing is that everything was wrong, not right with the bank. That's how you earn the respect from the investors. So you start a cleanup drive, and then your NPS goes up. You do provision, etc., etc. And then as that time to retire comes, knocks on the door, you want to leave with a happy note. So you do the same thing what your predecessor had allegedly done. So that cycle will definitely be now on exist. If somebody is not fit and proper, not morally, not ethically, or not in the governance thing, like fraud happens, even though they are rare, they don't get another term, or they are even asked to leave before their term ends. But you never hear a person is shown the door for inefficiency. I think we need to look at that.
You say there needs to be a comprehensive policy for financial sector to attract talent. One, do we need lateral entry for PSPs? And two, is there a need to revisit the compensation structure?
Yeah, when I said financial sector, I also included the All India financial institutions like SIBB, NABARD, Exim Bank, etc. Should their CEOs be picked up from the market? Yes, that experiment was done. In fact, Bank of Baroda had Jai Kumar, and then IDBI Bank, the current CEO, also had picked up from the market. But unfortunately, that was only one instance at one round. After that, I think it's not happening anymore. And how do you get market from a right kind of person from the market? Because the third part of what you mentioned is this: where is the market-related salary? If you look at the salary structure in public and private sector, at the lower level, public sector bankers get higher salary than their counterparts in private sector. But as you go up the ladder, the difference becomes very stark, and at the top it's hugely different.
Finally, one key question: should the government be in the business of banking?
Well, for that matter, why banking? For any business, Prime Minister Mr. Narendra Modi had said that government has no business to be to remain in business, to run businesses rather. So, and as you know that 2021 budget spoke about privatizing two banks, two public sector banks, two nationalized banks, but nothing has happened till now. There are so many constraints for a government-run bank. So, and at the same time, you expect them to run business like the private sector banks because they are listed entities and the investors have the interest. I mean, they need to make money by investing in the stocks. So that's not possible. So probably, and which I think it's a generally accepted theory, is this: government should have certain banks owned by government, and those banks probably should have the purpose should not be run like a business entities, but as a vehicle to address the socio-economic issues.
Thanks, Tamal. Thanks for coming on the show. We hope your book does well. Thank you again. Tamal highlights that while this is a good step, the government needs to do more to attract top talent. Moreover, he believes that compensation structures in the public sector need to change. Last week, we asked you a question on the relevance of public sector banks. We wanted to know if the government should keep more than 2 or 3 public sector banks. Nearly 3 out of 4 people responding to our poll said it should. The dilemma for the government is whether to pursue profit or to go for social outreach. It cannot achieve both. This week, we want to know if India should have more entities like the NPCI in the payment space. Our polls open on Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. More NPCI-like entities will spur innovation, but in that case, NPCI cannot both be a regulator and a competitor. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.